Sorry, no music today. How you doing, friends? This is 0 Days to Expiration, and it is Tuesday, January 10th. And today we're at the billiard parlor. The office is way over there, and it is currently going under some renovation, putting in a new 10 gigabit Ethernet network, and basically redoing all the wiring and everything. So it's out of commission right now. And unfortunately, the crews over there, they have all of my setup and music and soundboards and all this other stuff. So I'm here in the corner of the billiard parlor, broadcasting from here. And you can even see some of the crap that's sitting on my pool table, which I hope to get off very soon, as soon as I put everything back together. Just got what I needed in the mail. All right, all of that is done. Today was filled with a lot of anticipation, and it was filled with anticipation because Jerome Powell, the Federal Reserve chairman, was set to speak at 9 a.m. before the market opened. And anytime that the chairman of the Federal Reserve speaks, everybody listens. They stop, wait, see what he's going to say, whether or not it's going to impact the market. Is he going to slip something that will change their basic narrative of the day? And right now their narrative is mostly hawkish. So it was some kind of, I think, symposium. Was it in Stockholm? I'm not sure. But if it was, he got a free trip to Sweden. That's nice. It was a big downer, though. He got on, and the first 5 minutes, I guess it was the introductory, and maybe he took some Q&A, but I didn't bother watching it after that. He got on and started talking about climate change, and I have no idea what the Federal Reserve has to do with climate change. So anyways, there was of volatility. First, before he came on, the market tried to front run any kind of bad news, and so it came down in the morning, pre-market. And then when he came on, he didn't come on right away. They had a couple of other speakers, and then he did his introduction, spoke about climate change for a little bit, and then sat down. He was up for about 5 minutes. And the market had all kinds of volatility, and then it finally went down a little bit. I guess there was some disappointment. Then it slowly tried to climb back up throughout the day, and that's where we're at right now. I don't know if I can easily show this, but yeah. So this kind of illustrates it. We were, he did his speech, or he was introduced right around here, right? So maybe we can go to the E-mini. That will illustrate it a little bit better. So he was introduced, I'd say, right about here. So the market came down from yesterday, and here we are at the Indian Open right around here and still sideways. And then again, the U.S. market starts to come online, and they're trying to front run. And then they're realizing, what are we doing? And so just before the speech, before he gets introduced, it goes up a little bit. He comes on about here, I'd say. There was a little bit of a delay. He came on, he didn't say anything, and the market went up. And then he started talking about climate change, and then you got this kind of, I don't know what you would call this, but this volatility. People were stunned. What is this climate change stuff? How should I figure that into my portfolio? How does that figure into the future cost of money? Uncle Jerry, please help us. And he didn't help. He just kept on going on. And finally, I'm assuming he stopped talking, and then the market started to climb back up. And then here it is right now, 3 o'clock, and we're having a little bit of trouble. I guess we're doing a little bit of retrace. Will we end up higher? I don't know. My guess is that we'll probably, I don't know. It's hard to tell. This was where we were yesterday, up here. We are definitely lower. So there you go. That was the whole impact of Jerome Powell, one of the most men on the face of the planet, talking about climate change, which I have yet to figure out how that fits into the directive of the Federal Reserve. It makes no sense. But anyways, they say they're not a political organization. This absolutely proves that the Federal Reserve is 100% political. And they've done similar things where they've talked about race relations and other things, equity, and I have no idea what any of that has to do with the cost of money. Interest rates, that's what I'm referring to. So that's just another piece of the puzzle, another facet that we have to grapple with and get our heads around and understand. I just choose to ignore it all and just wait and see whether or not he changes his underlying narrative, which is basically hawkish. In other words, their number one goal right now is to try to get interest rates above 5%. And so it was stated yesterday, and that's the reason why the market was front-running this by pushing it down yesterday, because one of the Fed governors, Mary Daly from San Francisco, came out yesterday and essentially reiterated Jerome Powell's hawkish tone, saying that, yes, we have to get to at least 5%. We're currently at about 4.25%. So we have our next Fed rate hike scheduled for the 1st, which is just 3.5 weeks away. So then they will decide whether they go 25 basis points, 50 basis points, do nothing. No one really knows. And it seems like right now what they're trying to do is shake us up a little bit. Sometimes they inject a little bit of positivity, then a little negativity, and then depending on which Fed comes out, I think they're coordinated. I would assume that they are. They wield so much power, they better be coordinated. So it's all a game. It's all a word game. They talk about the tools that they have at their disposal for managing the economy. They have no tool. Their only tool, besides them being tools of the political class or whatever, is words, basically. A narrative, whatever narrative they can portray. They can make the investing community believe what they are going to do. And then it goes beyond the pale. Can they actually control the economy? So I don't really think that they can. I don't think that they know how. They're always either late or behind, overshoot, undershoot. And to me, it appears that they are just conducting one big experiment all the time without any conclusion, without any real way to grapple with the cause and effect of what they do. But they do what they do, and we still follow them, and you have to follow the Fed, and the prevailing wisdom is don't fight the Fed, which is probably good. It's kind of like that movie Idiocracy, right? It doesn't matter if there is no logic or reason being injected into the conversation. You just do what is going to essentially keep yourself as safe as possible. But that's our Fed right now. So anyways, I can't punch Bob from here because he's 15 feet that way, and so I can't reach him. He's on the other side of the office, the other side of the billiard parlor. Yeah, he's way, way over there. But he says hello. Bob says hello. That's Bitcoin Bob I'm speaking of. And he does deserve another beating. And I promise you, after I finish this podcast, this little sit down, I'll go over and I'll give Bitcoin Bob a good beating. Speaking of Bitcoin, where are we? I do not know. Let us take a look. Let's see. We don't want that. Let's do this. Crypto CUSD. We'll look at, should we look at Binance's version of Bitcoin? Is that the version we should be looking at? I have no idea these days. Does it matter? It looks like Bitcoin is on a little bit of an upswing. Of course, that's going to get all the Bitcoin maniacs completely juiced. And I'm not showing it, am I? Here we are. Hold on. So let's look at the last few days. Yeah, so the last few days we've been moving up. Moving on up to a deluxe apartment in the sky. Yeah, look at that. We're on the upswing. And of course, gold has been on the upswing lately. Check this out. Since November, the November lows, we had a triple bottom, and then gold has just been on a tear. Look at that, right? I've been talking about that since November, quite frankly, saying that you should be buying gold. I believe that gold will achieve a new high this year, and it doesn't have too high to go. Further to go. That would be 2071, or right around there, 2070. Gold is on its way. Now, this is interesting. I look at gold, and the prevailing wisdom is that gold is an inflation hedge. Now, why is gold coming up now when all the reports are that inflation has peaked and that it's waning? And while inflation was rising, why was gold going down? Or was this initial peak, does gold front run inflation? I don't know. But everything that you're told about what gold is supposed to be, other than the fact that it is a definite store of value, everything that you've told that it's about it being an inflation hedge, it doesn't really bear out in the charts and comport to or in any way follow or correlate to inflation. At least I don't see it. Do you see it? Maybe if you looked at it from a really long-term point of view, and let's see, we'll put on a weekly. From here, maybe this is what we're seeing, right? So back in 2019, but if we go way back, let's do the Wayback Machine, all right? So maybe what this is saying is that all of the government spending and everything else, this is representative of that. So you have to look at it from a big picture point of view. But man, doesn't that look like, let's see, we have what looked like a bull flag, and then it just did this whoop-de-doop. But now we have what appears to be this huge, I don't know, would you call that a cup and handle? Not that it makes a difference. I don't think the market has any idea that, oh, gold's in a cup and handle, therefore it must break out. But we have a mini version of that up here. It looks to me like we're coming back up for this. Now maybe this will become the next triple top, right? We had a double top, it went down. I'm just spewing off crap about chart patterns. I don't know what it's going to do, but I look at this and I think, oh, okay, we did this is like one epoch or epoch in our history. And we came out of the big recession, and then everything was good and gold wasn't really needed, and Bitcoin started to make its upcomings, right, all through this era here. And then gold found some more value. Apparently, maybe this is the effect of inflation here. But I don't know. I just don't know. It doesn't seem to correlate. But right now, it's moving up again. And by all accounts, inflation is waning, or it has peaked. We've reached peak inflation. At least that's what a lot of the economists and armchair economists are saying. So where are we going? I have no idea. I don't think trying to make sense of all this and looking at your studies or any courses that you took in economics and what they taught you inflation was and gross domestic product and all this other stuff, and none of it really falls in line with what the academic definitions or the use of those different types of assets and things. None of it works because it's all manipulated. So who knows? I see gold going higher. And the reason why I see gold going higher is that our nemesis, and we're forcing the hand of our nemesis, and I'm referring to the communists and communist wannabes and socialists over in Asia and Russia Minor and China. They're all talking about evacuating the US dollar, the petrodollar, and basing everything on their own dollar, maybe the yuan or whatever. And Russia now is only accepting payment in gold for their oil. We had supposedly been cutting Russia off and doing all kinds of things that would bring them to their knees. But Russia just went to China and they're making all kinds of pacts, and it looks like they're going to divide the world and create their own reserve currency. And so what's that going to mean for the United States? It just seems like everything that we do where we think that it has some sort of bullying or effect is just backfiring on us. And I believe that's where things are going. So why is gold going up? Because I believe that the world believes that China and Russia together, and maybe even India, you'll have the greatest populace or the percent population of productive people in the world all on a gold standard. Maybe that's what's happening here. But I think that's going to happen no matter what. So I would be a buyer of gold. Buy gold. All right. That's that. What else is happening today? We got the Fed, we got gold, we got Bitcoin that nobody knows what's going to happen with that. Tesla's down today. Why is Tesla down? Why? That doesn't make any sense. Tesla, I would say destined to be the most valuable company in the world eventually. It's just my opinion. What do I know? Let's see, what else do we have here? I wanted to show something else. Yes. We're going to talk about the butterfly today. As 0 days to expiration is an event in the life cycle of an option. And what it is, it's the very last day of an options life cycle. And why it's so significant is that it presents a unique opportunity for traders like ourselves to be able to trade that last day of expiration in the extraordinary decay in premium. And I went over this yesterday a bit. So if you're interested, go back and look at yesterday's video. But in the current world, we into short-term stuff, short-term trading, because there's inherently less risk and not worrying about overnight risk and just dealing with what happens that day. Now, the SME and the CBOE have gotten together and decided that instead of weekly options, we're going to expand the whole idea of weekly options and bring it to daily options. There's still weekly options, but instead of, say, just expiring once a week, or like most stocks do once a month, and having that 0 DTE event, we're going to do it 3 days a week. That's the way it used to be. And then recently, it was such a hit that they decided now, in order to satisfy the demand for trading 0 DTE, they decided to go to 5 days a week. So now you can have a weekly option that expires every day of the week. Monday, Tuesday, Wednesday, Thursday, Friday. And why is that so cool? That is cool. First of all, it wouldn't be cool unless there was enough people trading it. Because if there weren't any people and the liquidity was low, it would be a drag. But institutions and investment houses and proprietary trading firms and all the retail traders and professional traders, they can't get enough of zero DTE. And so they're trading that. They went to 5 days a week. And what that means is it's an option that lives for about 8 days. It is each day, like today's option on Tuesday was born 8 days ago. Yesterday's option was born 8 days from there. Wednesday's option that is expiring, it was born 8 days prior to that, right? So these options, they last for 8 days, and then they're decaying at an exponential rate until they get to that last day. Now, the cool part is that the premium that's in those options is pretty substantial, and volatility right now is relatively healthy. So there's a lot of premium and pretty good action and pretty good liquidity to get in there and take advantage of that premium decay. How do you take advantage of it? As a buyer, it's very difficult to take advantage of it because it's working against you. As a seller or a writer of those options or being net short an option, you can collect that premium. And because it's decaying at such an enormously quick rate, and because there's so much of it, nearly half of all the premium that was available in that option over that 8 days is available in the waning hours of that final day. That is a huge advantage. I'm not sure if coffee is going to help that. So anyways, that's what we do. We are net sellers or net short on options, and we collect that premium. Or we use various types of option strategies that are needed to collect that premium, whether it's net short or not. The butterfly is perhaps not as popular as what most people do. Most people are doing strategies like the iron condor or a credit spread or even any old vertical to try to collect that premium. And the reason why they do that is that they want to create a very high probability strategy. Now, when you put on a high probability strategy, what you're doing is you're slicing something. So in other words, if you went to the racetrack and you wanted to bet on the horse that was absolutely guaranteed to win, right? How much payoff do you think that they would give you for the horse that has a 95, 99% chance of winning? They would give you very little payoff, and you'd have to put up a lot of money to get that little bit of money, that little bit of winnings, right? It's the same thing here with things like iron condors, where people want them to be very, very wide so that they can account for a very wide range of price movement and almost guarantee, not quite, almost guarantee that they're going to profit. So when they do that, though, they have to put up a big amount of money, $500 or $1,000, to make maybe $50, usually something a little bit less than that. So that's the way most people trade. And in fact, that's the way most people trade in general. They like these high probability strategies, and they're willing to put up all of this money. And what that does for most traders, and particularly retail traders who are not really great at controlling their discipline and their process and so forth, it puts them into a bind, and quickly they'll go into an unrealized loss while they're in most of their trades. And that makes them panicked, nervous, anxious, and that anxiety causes all kinds of fear that they could potentially lose huge money while they were only going for that tiny little profit. And it makes them scared and do rash things like try to fix the problem when there's really no problem to fix. And they'll make bad decisions because of it. So while this zero DTE thing sounds great and you can get out there and you can make tiny little bits of money, there's always that chance that you're going to. And it's not just a chance, it's an eventuality. It's a certainty that eventually you're going to hit one of those risk sides, right? And it's going to hurt big. You'll soon forget it and say, oh, it must have been some kind of mistake on my part. I didn't see it coming, or the market never moves that way, or yeah, that's the first time I've ever seen anything like that, or I had to go to the bathroom. The wife was talking to me, or whatever the excuse is. Those are all excuses I've used in the past, by the way. Sun was in my eyes. I've never used that one. There was an earthquake. I've never used that one. But I'm sure those are all valid excuses for losing lots of money. A lot of people look at trading this way and they characterize it saying it's like picking up nickels in front of a steamroller. Sure, there's lots of nickels and you can pick them up, but man, eventually you're going to trip, or the cuff of your pants is going to get caught into the steamroller and it's going to go. So that's what happens. And it's not maybe or if. It is an absolute eventuality that you will do that, and that's why most people, when they're trading high probability strategies, why they lose money and blow up their accounts. It's not the only reason. It's a stupid choice for a strategy, and it has no long-term expectancy. It thinks that they can manage the risk away. Now, if that were just manage your risk and control your emotions, if that were then everybody would be doing that, right? There must be some sort of prescriptive plan to do that and be able to control all that and then escape the danger of that steamroller. Yet 98% of day traders lose money. That's just the way it is. They lose money because it's a ruse, a canard. It is a total lie that is an effective way to trade. Here's the thing is that most professional traders don't trade that way. Virtually all successful people that I know of trade in an asymmetric manner, where they're looking for asymmetric returns. They take the smallest possible risk for the maximum possible gain. That's what they do. That's what pros do. And funny, 98% of those retailers and others, even a lot of pros and even some semi-pros, are losing money day trading. But the ones that are winning are typically these asymmetric traders that are pros. So you would think that people would smarten up and say, man, that's what we should do. See, the problem is that there's a barrier to get over for them. They need to retrain their brains. I'm leading up to butterflies, by the way. This is all leading up to butterflies. They need to retrain, reprogram themselves. But that is a very difficult thing to do all on your own when everybody else is doing it that way, saying, this is the way you must do it. The beatings will continue until morale improves. That's basically the situation that you're in. You're in idiocracy. Every once in a while, a service like ours comes along and attempts to break you out of that and show you that, hey, there's a better way. There's a better way. You choose. Now, here's the cognitive dissonance that is in this, right? When you're doing these high probability strategies, you really enjoy making those tiny little wins because every little win is like another little pearl, right? And although it's a fake pearl, but it's still a pearl, right? It feels good. Another pearl. Or in reality, it is something that's more physiological. It creates in our lizard brains this kind of dopamine drip because we like winning. That's the opposite of losing or danger. With danger, we have this sort of fight or flight, and usually it's this flight. We run away from danger because we feel that's the best thing to do. But when there's no danger and we're getting this little sweetness every little while, we feel good, and it trains us to like high probability strategies until it punches us in the face. But we can get up and we can get over that because we're programmed to go right back to that dopamine drip. That's what it is. It's a dopamine drip. We are hooked on feeling good. So it takes a lot to reprogram yourself and get over that, to do something that goes against your lizard. And that's really the case in just about anything, right? Most people in their careers, they choose the path of mediocrity, the path that is bribed by them, by society. Go to school, get a job, be a slave. Collect your weekly income, stay just ahead of a disaster, but you're okay, it's happy. And then you'll get retirement and you'll have just enough to feel okay, right? Anything happens, you're screwed, but that's what everybody does. The people in this world that make it do not go that high probability way. They take the low probability, tiny risk, asymmetric return. They take small little chances, and they know that they're going to fail. They're going to fail a lot, but when they win big, and they stack those wins. And so they try again. A little win, a little loss, big win. Stack that one up. And then before you know it, they've got a bunch of these little things going on. Little loss, big win. Little loss, big win, big win, big win. And then they just keep on stacking them. All right? So that's how the rich get richer, the wealthy get wealthy. They do it through asymmetric returns. Virtually everybody that is in that category employs that type of stuff. Just all you got to do is really look at it. You look like a venture capitalist, for instance. A venture capitalist, that's really their primary is to take their money and spread it out a bunch of companies that have potential, but maybe they are going to make it, maybe they aren't. We don't know, but we spread it out. And out of that 20, 25 companies that they spread their money out on, 80%, 85% of them fail. 5%, 10% of them might make just enough to cover all their costs. And if they're lucky, they'll get that one Apple or Microsoft or Amazon, and it will pay off. That's how a venture capitalist makes money. Someone who's in real estate, man, they are the kings of leveraging asymmetry. And so is the case with virtually every other profession, whether it's an artistic endeavor or physical or anything. Everybody focuses on they invest in the knowledge and the opportunity, and they know that they're going to fail a lot. But if they keep on going at it, eventually there's some big payoff. That's how you get wealthy. That's how we conduct our trading strategies. And that's why the butterfly is so important. That is why the butterfly is so important. Am I seeing something? Is something changing? Are we getting back in the money? Is the market moving up again? It is. All right. So the butterfly. Now, I talked about the iron condor. And like I said, they like the condor because they can spread it way out. Now, the butterfly is very much like an iron condor in that they're both made up of a bullish spread and a bearish spread. And they're way out like this. The strike that's up top here is short, and the strike down here is long. So they have a long and a short strike on either side, like this, right? But they spread it way out so that in between they can make a profit on. Now, a butterfly is a lot like that, except that they make the short strike on both the bull and the bear spread the exact same. And by doing that, you have this kind of triangle shape. But it doesn't cover as much range as the iron condor. And you can also play it like an at-the-money strategy like the iron condor, and that's the way most people do it, and they look at it as a market neutral. But there's a much better risk to reward on it. Not the kind of risk to reward that we want, but it's much better than an iron condor. So it might be something like 1-to-1, or maybe even 1-to-2, or something like that. 1 part risk, 1 part reward, or 1 part risk, 2 parts reward, or maybe even a 3-to-1 is okay. That's better than, say, a 20-to-1 that you have with the iron condor. Much better. But it's still a relatively low probability that you're going to land somewhere inside of that spread, and even lower that you're going to get that maximum profit. The profit is much bigger than the iron condor. So what is the answer? The answer is that forget this high probability crap, right? If you want a spread that has real potential, push it out of the money. Sure, your win rate is going to go down, but your cost is going to go down too. And the ratio of your cost to the potential win starts increasing dramatically. And as it is with the butterfly, if you take the butterfly and push it out of the money, push it away from you, the cost starts going down, and then the potential reward to the cost starts going way up. And so now instead of a 3-to-1 or 2-to-1 risk to reward, you have a 1-to-5, 1-to-10, 1-to-20 risk to reward, starting to sound more like a lottery ticket, but with much higher odds, or sound more like the venture capitalists or the real estate investor or anybody that does investing or anybody that does anything that is worthwhile, where they know they're going to fail a bunch of times, but when they do hit it right, it means everything. It's not mediocrity at all. This is going for the big one. So that's what we do on the Zero DTE event. The butterfly is a premium collection device. We're looking to we know that it's going to be very difficult for us to pick the right price at the right time. We also know that it's very difficult to pick direction. We don't know. And we also don't want to go broke in this effort, right? If we're wrong, we want to be wrong small. But if we're right, we want to be right really big, really big. That's what we want, right? So that's what we're going for. We take small risk for a huge potential return. Now, from a mathematical point of view, this has a long-term expectancy. Now, wouldn't you know that the other side, the high probability side, even though it seems like you're going to win a lot, it actually has a low probability, low expectancy. So it's ironic that the thing that makes you feel good all the time is eventually a losing strategy. And the thing that, I wouldn't say disappoints you, but makes you patient is the thing that is going to ultimately win for you, right? So that is the difference between what other people doing Zero DTE are doing, or the vast majority of people, the retailers and all the losers, and then what the winners are doing. The winners have patience. The other guys don't have any patience. They want the dopamine drip. We don't need the dopamine drip because we have math on our sides and we understand what the potential outcome is. On top of that, our drawdowns are super small. We never have to worry about our drawdowns. Our drawdowns are small. If you were on the high probability side, man, if you had a max drawdown of, say, 10%, you would be a god among gods if that's the max drawdown you ever had. I never have much more than a 3 or 4% drawdown. Am I a god? Oh, maybe. But no, it's the speed that I choose. The speed that we choose because we take small risks, we're able to put more of these risks on. We're able to put them in places. We're able to create different types of opportunities. And then the reward that we get is outsized, huge. And when we get those big rewards, we can stack them. So that's what we do. Now, how long did it take me to get to that? It took me a long time to get to that point. All right. And the market's not really doing anything different. Is it going to go up? I don't know. So what I'm going to do is show you what I've been talking about. So here's your prototypical symmetric butterfly. A symmetric butterfly is made up of a bullish and a bearish spread. So on the left-hand side is the bullish spread, right? Because its face is pointing to the bullish direction. And the right-hand side is the bearish spread because it's pointing to the bearish direction. And then they're sharing the same short strike. So there's a long strike here, 2 short strikes, and a long strike. So a lot of people will say that's a 1-2-1. And then the spread on both sides has the same width. In other words, there's the same between the strikes. From this short strike to this long strike, and from this short strike to this long strike right here, all right? So that's a symmetric butterfly. And you can see if there's an element of risk and then there's some reward. If price stays somewhere inside of here, now, this isn't the only place where price can make money, by the way. This is all at expiration. This is what the risk graph looks like when this strategy expires. But before this expires, there's a real-time risk profit line that extends way out to either side on the butterfly. And that's what a lot of people aren't taking into account, that it's not just in between here and here. There's a whole range of places where you can profit if you were to decide to get out before expiration. But if you want the maximum profit, you'd bring it to expiration and you'd be somewhere inside of what's called the profit tent of the fly. All right. So this is the difference between a symmetric fly and a broken wing fly. The cool thing about a broken wing fly is that it has asymmetric risks on either side, which is interesting, where this has equal risk on either side. I'm not saying that the broken wing is better or the symmetric is better. They're just different. And the reason why the broken wing is different is because the spreads on the bullish and the bearish side are unequal. They're not the same. So this one here might have, say, 2 strikes between the bullish long and short, right? And then on the other side, it might have 3. So the one with more strikes between the long and the short strike usually has more risk associated with it. The one with less has less risk associated with it. So that's really the difference between a broken wing. A lot of people like to use the broken wing as a directional device, or if they have some kind of idea about where the market is going to go, and this models their idea, they'll put one of these on because they feel like there's less risk on one side than there is on another. Or maybe the risky side is so far away that it doesn't bother them that much. They are willing to take it for the opportunity to get into this trade a lot cheaper. So that's why they would use the broken wing. That usually doesn't work out, but that's the reason why most people convince themselves to put it on. Pretty much the same reason why most people convince themselves to put on high probability trades, because they've conjured up this excuse in their head that as if they know more than the market. I'm not being cynical, am I? All right. Now, here is the difference between, now both of these are symmetrical butterflies, but on the left-hand side is what most people will do these days. They'll put it on so that it's at the money. In other words, when they put on this fly, the market price is right here in the center. That's what MP stands for, the market price. So you're in the market, and let's say the market's at 3,200. That's where you'll put the short strikes, and then you'll put long strikes on either side. So you're right in the center of the fly. And the problem with that is that the reward is small compared to the risk. This is really the same thing as an iron condor, only it's a little bit better than an iron condor, but it's still pretty much the same, where you have small reward, big risk. With the iron condor, you have really tiny reward and huge risk, right? And now, the one on the right is what we do. What we do is we push it out, and instead of making it a market neutral like it is right here, we turn it into a directional strategy. In other words, price needs to go towards our fly in order for it to make money. But by doing that, when we push it away, it changes the risk to reward scenario dramatically, where the risk is small and the reward is huge. Now, this point where this becomes a really good strategy, long-term expectancy. And that point seems to be optimized around some risk to reward ratio. And it might be a little bit different depending on the market that you're in, but generally we find that the 1-to-9 risk to reward ratio seems to work out best. In other words, the risk is, say, $1, and then the reward is $9. Now, so that's one aspect to it. So that's what we do. That's how we create our asymmetry, our asymmetric reward. Now, of course, if we don't go towards the butterfly, we lose, but we only lose the risk. If we go towards the butterfly, then we potentially win, or win a lot compared to the amount of risk that we take. And as it turns out, even if we were to look at a sort of a random market, for the most part, this type of strategy ends up doing very well. With some minimal profit management, you can do very well this way. And this is particularly well suited for the zero DTE environment because we're collecting premium. That's what happens underneath the profit tent of a butterfly. Your premium collection happens inside there. The profit is slowly growing until it fills up the shape of this butterfly right at expiration. This is the perfect zero DTE tool. It gives you that asymmetric return, risk to reward, and it collects profit. And the way you make it, the faster it collects it. All right, let's go on to the next thing. So here's another very interesting thing. Volatility has a big effect on the cost of an option strategy. When you're in a very low volatility regime, that cost increases. So in other words, the butterfly sinks low. It's like low tide. Imagine zero line is the dock, and your butterfly is the boat. During low volatility regimes, or when volatility is low is another way to say it, the boat sinks low. It's sitting low according to the dock. When we have high volatility regimes, when the water is rough and it's high tide, our risk to reward, the boat is floating very high to our dock. So our risk is very small. It's easy to get on that boat. So that's something you should keep. Now, conversely, if you're inside of the butterfly, you're already in the trade, the high volatility regime works against you. Once you're in it, you want it to go to low volatility so it sinks and so that the profit comes on you quicker. So it's better to get in while it's high and better to be in it while it's low. That's only, but you can work around that. All right. Let's see where I skipped. All right. So another thing that we found is that in low volatility regimes, it's a little bit easier to get the kind of risk to reward that you want with a narrower fly. And that's mostly because the expected move is much smaller. You can get a better risk to reward in that low volatility regime to some degree, but in order to get it, you need a much narrower fly. In a high volatility regime, you can get a much wider fly and get that kind of risk to reward. That's basically what it's saying, that in higher volatility regimes, we can get better pricing and wider flies because the market is moving a lot more. So it prices that in. But you have to push it further out from the market price in order to get that. But that comes with its own set of characteristics that you need to know about in trading zero DTE and how to optimize that. All right, on to the next. Now remember, I talked about the premium, that it's growing inside of the fly. So you'll see that this blue line, the cyan line, represents the premium growing inside of the fly. In a 1-to-1 risk to reward, that premium is sitting the butterfly is sitting really low. And so when you first get into that trade, the curve for that premium is really tall, like that. When you get into something that is sitting high, like I showed before, that profit curve is much flatter. Now, what I'm showing here is the delta, and that's the change in price and its value. But what that really should say is gamma. That should say gamma. Who put delta there? Who did that? So the gamma is the sensitivity to price movement back and forth. So in this in this 1-to-1 risk to reward, what most people like at the money, your gamma is higher. So your sensitivity to price moving back and forth is much greater. In other words, while you're in the middle here, you're great. But if you're sitting low like this, then any price movement left or right is going to drastically affect the value of your. And if it moves too much to one side or the other, you're going to be in trouble. But when you're sitting high like this, that profit curve is flattened out and your gamma is lower. And so now you're less susceptible to changes in price. So another reason why we like out of the money, higher volatility situations. So this is going back, talking about the iron condor, because I have to throw that back in there so I can punch them in the face. While at the money, having a butterfly gives you bad gamma, not bad delta, at least you have a risk to reward that's with the iron condor, your risk to reward is much worse. This is illustrative of that. And because of that, your profit curve has a much steeper curve to it. That steepness means that the gamma is worse, the sensitivity to price moving side to side. So even if you have a high probability and you're sitting right in the middle, as soon as price moves one way or the other, you start going in the red. With the butterfly, you also start going in the red if you're at the money, but it happens at a slower rate, a much slower rate. If you're out of the money, like I showed back here, right? Or let's see, even going up here like that, then your profit curve is shallow. See, right here. Here it is. See how shallow that is? Much better situation. Your gamma risk is very small. So what it's saying is that when you're out of the money and you have a good risk to reward, everything about that trade treats you better. You just feel better. You're in less peril. It's easier to manage. You have less money on the line with more potential profit. Everything about trading this way is just in a different category to high probability trading. Now, it's true that our chances of actually winning, the win rate, is definitely lower. But win rate isn't what makes you, it's the long-term expectancy or the actual return that you have on a daily, monthly, weekly, monthly basis. The return on this type of strategy, even though it's lower probability, is way higher. In fact, generally, it's considered to be positive, where the other high probability is generally negative. So isn't that kind of a twist? That the high probability is telling you that you're going to lose, and then the low probability is saying, hey, you're going to win. That's it. While this is a bad butterfly, this is a really good butterfly. No matter how you look at it, that iron condor sucks. So this is demonstrating an out-of-the-money butterfly and the growth of the premium during the course of a day. In the beginning, it starts off really flat, and it's growing. And you'll see that each one of these T's in a time, maybe is when you get into it. T3 is maybe 11 o'clock, 12 o'clock. T2 is maybe 2 o'clock in the afternoon. T1 is maybe 3 o'clock in the afternoon, right? So that's how the profit grows until it finally fills up the butterfly at expiration. And so that's the growth of your profit. Now, the interesting thing here is that you can be outside of the butterfly. You can be at T2 or T1 and still make profit. As a matter of fact, you can make a lot of profit. That profit right here near the edge can often be as much as 125 to 200% return on your risk without ever getting into the butterfly, as long as you exit that before the market closes. And of course, you'll be profitable all day long as long as you stay inside of the profit tent. So there's the market. What happened? Oh, look at that. What happened? Oh, we made money. Yay. It ended up inside of the profit tent. This is my right here. Ended up right here. Made $43, $45, somewhere around there. I don't know how much. Somewhere around there, about $46 it looks like I made on risk of $49. Now, I could have made as much as $350, but it didn't move all the way over there. That's okay. So there's an illustration of how all that works. So the market made a last-ditch effort up. Fantastic. That's a wonderful thing. We love that. All right, there you go. There's everything you've ever wanted to know about the butterfly. Not quite everything. That's only scratching the surface. But it does show, and I just showed a butterfly, a broken wing that I had on that worked well. And it made money today. Pretty good return, too. About almost 100% return. Now, see, that's the other thing. We just made almost 100% return on our risk. When those other guys using the iron condors, when they're putting on their trades, their max that they'll ever make is about 5%, maybe 10% tops. That's crazy. And that's maxed out. Here, I got a minimal win, and I was almost at 100%. There are some times I can make 800, 900%. That's the difference. We didn't get to the roll call. I'm really sorry about that. We'll do it quickly here. We're going to say hello to Will Do. How you doing, Will? And Steven's here, ready to get some earning on it. Very good. And Iz with his double barrel hello. And Jay Hen is here. Anything in Washington is political. That's true. Yes, Idiocracy is a classic. Great movie. Craig is here. How you doing? And Got Worms. Seems like everybody is moving to, there we go. Seems like everybody is moving to cash right now. So maybe gold is a similar mindset. Yeah, I'm heavily in cash. And our strategy in general is very heavy in cash. And we have some more comments by Got Worms. I'm sorry I didn't get to all these earlier. So Greg wants to know, so besides S&P 500, I am doing butterflies on GLD and Tesla and Amazon and Apple. Good for you. He's a zero DTE maven. And is saying, using zero DTE allows you to take advantage of the accelerated premium decay on the final day. That's exactly right. And 123 Happy Street is here. So we did get through the roll call. So there you go. All right, we're all done here. I want to thank you very much for showing up. We'll be back tomorrow with more on zero DTE. We'll talk about our trades, the analysis of the markets, and then in the final half of the show, we'll pick up a topic that is specific to trading zero DTE, the zero DTE event. Oh, there's a question here. Can you help me understand, if we enter a debit trade, how are we net premium sellers? Because we're not net premium sellers. However, we are collecting premium. So forget about being net premium. In the butterfly, we are collecting the premium as it decays. So that's all that really matters, right? If you were making money and someone said that unless you call it green, then you're not making money. But what if you're making money and it's called red? You're still making money. You don't care if it's called red or green. Same thing here. We don't care if it's called net premium or debit. We're still making money through the collection of money. Hey, Barry Wyatt, good eye. All right, all set here. I need to go walk the dogs, and I'm going to come back and then finish up the upgrade of my streaming studio, and we'll see you tomorrow. Sorry, there's no goodbye music. Just me. Take care. Peace to you all. Dude, bye.